Occidental Petroleum recently announced earnings for the second quarter of 2023. Their stock is down 2%, while the rest of the market is up 3%. So they're underperforming the market right now. But in this video, I'm going to look into some of the recent news that came out surrounding Oxy. I'm going to look at their financial statements to get a better understanding of the financial health of the company. And then lastly, I'm going to figure out the weighted average cost of capital for Oxy and also use a discounted cash flow model to figure out the intrinsic value per share for this company. Right here, this article is titled Warren Buffett's favorite energy stock reported profits falling nearly 80% in the second quarter. Basically, for their second quarter earnings report, they reported missing profit expectations, but they matched the revenue expectations for the second quarter for Q2. The oil and natural gas prices in the first half of the year have continued to take their toll, but despite that, Warren Buffett has continued to invest in those areas. Right now, he basically owns 25% of Oxy, increasing his stake pretty substantially. So that's obviously a pretty hefty position of Occidental Petroleum for Buffett. He's clearly very bullish on the stock. Right here, we can see that pre-tax oil and gas income for the second quarter of 2023 was $1.1 billion, down 73% year over year. That's a pretty substantial decrease in earnings. And lastly, on this article, we can see Oxy repurchased $425 million of common stock in Q2. They've completed about 40% of their $3 billion repurchase program. So they still have a lot more stock to repurchase. And if they're going to do that, that's going to increase the share price in the short run. So right here, we can see these are the financial statements. Their balance sheet shows that total assets came out to $71 billion, down from $72 billion from the prior period. And then for their liabilities and equity, we can see they have about $29 billion of total equity. So that means that for their liabilities, they have about $40 billion total. So most of their business is made up of equity. And then we can see that for retained earnings, that's increased from $16 billion to $17.7 billion. Right here, this is their income statement. We can see that revenue decreased year over year from $10.7 billion to $6.7 billion, down 37% year over year. So again, pretty steep decrease for Oxy's revenue. And then for earnings, we can see that earnings decreased from $3.5 billion to $605 million. That's down 83% year over year. So really steep decrease in revenue and earnings for the second quarter for Oxy. Then lastly, right here, for their cash flow statement, the first half of 2022 compared to 2023, operating cash flow decreased from $8.5 billion to $5.9 billion. And we can see cash dividends came out to $688 million for the first half, up from $539 million for the first half of 2022. So it looks like they're prioritizing returning value back to shareholders more this year than they were last year, which is definitely a good sign for shareholders. Right here, we can see this is my discounted cash flow model. I'm using a growth rate of 35%, which I got from this historic growth rate calculation. Their free cash flow in 2018 was $2.6 billion. In 2022, the most recent full year, it was $12 billion. Over 5 years, that's a compounded annual growth rate of 35%. That's where I got this growth rate estimate right here. Cut that in half for the next 5 years after that to be conservative. For the weighted average cost of capital calculation right here, it came out to 8.8%. I basically took the book value of their equity and debt, which was $30 billion and $42 billion for liabilities, their interest rate for 2022 on their debt, which was 5%, their effective tax rate, which was 6%, the current 10-year treasury yield, which is about 4%, Oxy's beta, which compares the volatility of their stock to the overall volatility of the market, 1.78, so they are slightly more volatile than the rest of the market. Average stock market return for the S&P 500 is 10% per year. And so with that, I calculated their cost of equity, which is a risk-free return of 4.10, plus their beta of 1.78, multiplied by the market return of 10 minus the risk-free return of 4.10. That gave me their cost of equity 14.6% compared to their cost of debt 5%. We saw that about 40% of their balance sheet was made up of equity, 60% of debt. And so based on that, I found their weighted average cost of capital by multiplying the equity proportion by their cost of equity, adding that to the debt proportion multiplied by their cost of debt, and then multiplying that by the tax yield, which is 1 minus the tax rate. That gave me their weighted average cost of capital of 8.89%. Their free cash flow for the most recent full year, as I stated, for 2022 was $12.3 billion. They have a net debt position of $20 billion and 890 million shares outstanding. That puts their intrinsic value per share at $725 per share. This is obviously very optimistic considering these growth rates. Keep in mind, these are historic growth rates over the last 5 years. It's basically making the assumption that they're going to be able to grow at this growth rate for the next 5 years. But keep in mind, the energy market is cyclical. It has its ups and downs. Oil prices increase and they decrease. And that's what determines whether or not a company's stock price will increase or decrease in the oil industry. But based on that, you can see Oxy's share price is $62 per share. So that means that they would definitely be trading below intrinsic value per share at the current share price. The recent hike in oil prices over 2022 and 2021 really ended up giving these oil companies a lot of cash, and a lot of them used it to pay down their debt and reduce their liability positions. And so that makes them obviously a lot healthier. It increases their cash position and makes it easier for them to survive in difficult times. But that being said, I'm not sure if I would base my investment off of such an optimistic assumption, but I am going to use this growth rate estimate for the purposes of this video because this is their historic growth rate. So if they are able to grow at the same rates over the next 5 years that they were able to grow over the last 5 years, then that would mean that this discounted cash flow model would be producing a pretty accurate result. Right here, for their competitor industry analysis, I compared them to ExxonMobil and Chevron. We can see they have the highest gross profit margin, highest net profit margin, highest return on assets. They have the highest price to earnings ratio at the moment, and they currently pay the lowest dividend of a 0.83% dividend yield. So for every $100 you invest into Oxy stock, you're getting paid 83 cents per year. But based on this, it looks like from a profit margin perspective, you definitely want to give it to Occidental Petroleum. But if you were looking to invest in the company that paid you the highest dividend, you would want to buy into ExxonMobil stock. Lastly, I wanted to compare Oxy to some of the other companies we've looked at in past videos. Based on that extremely optimistic discounted cash flow model assumption with the 35% growth rates, we can see Oxy comes in first place with a 9% share price compared to intrinsic value, because their share price is $63 per share, just about. Intrinsic value is over $700. Besides that, AMD, Google, Albertsons, Alibaba, and Etsy are the only companies we've looked at that are trading below intrinsic value per share. We can see that in terms of growth rate, Oxy is put into third place with a 35% historic growth rate. Gross profitability came out to 40%, not good enough to get them onto the gross profit table. We can see that for net profitability, they have the highest out of any company we've looked at, 36%, higher than every single company on this list. And then for dividend yield, it was pretty low at 0.83%. The number one spot goes to Intel so far with a 5.52% dividend yield. Year over year revenue growth and earnings growth was negative. We saw that revenue growth was negative 37%, earnings growth was negative 83% for the second quarter. So that's definitely not good enough to get them onto these tables. Tesla has the number one revenue growth spot for the second quarter at 47%, and Intel has the number one spot for second quarter earnings growth at 400%. Lastly, for their stock performance over the last 5 years, we were able to see that right now they're basically down 21% over the last 5 years. So that's not good enough to get them onto the table. We saw right here from 2020 up through to 2022, oil prices increased substantially. So their stock price did increase from $13 per share up to $70 per share at one point. So they were pretty much killing it over the 5-year chart, or over the 3-year chart basically at one point. But since then, their stock has kind of just stagnated. Right here for the chart, Tesla has the number one return over the last 5 years at 1,144% when they were trading at $258 per share at the time of making that video. So based on this, it looks like they're not really that competitive for stock performance and profit margins, except for net profitability. Revenue and earnings growth and dividend yield, not that competitive, but for growth rate and share price compared to intrinsic value, they are very competitive. But keep in mind, it's also a very optimistic analysis, so I wouldn't really take it at face value. I'd encourage everybody to do your own due diligence. Right here, compared to their competitors, we can see they have the highest profit margins compared to Exxon and Chevron, but they pay out the lowest dividend yield. So let me know in the comments section down below what you guys think of Oxy. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.